What is going on, investors? Hopefully you guys are doing well out there. Time to kick off earnings season with earnings from Taiwan Semiconductor Manufacturing Company, otherwise known as TSM. Over the last year, this stock is down 32%. Year to date, though, this thing's been in rally mode, up 17%, including 6% after reporting their Q4 earnings. This was really early this morning for most people. Revenues came in at $19.9 billion. We'll come over here to the financials and we'll walk you through these, get you comfortable with what happened in the fourth quarter, a little bit for the full year as well. That 19.9, nearly $20 billion worth of revenue was 26% growth year over year, but it did miss expectations by about $1 billion on the earnings side. They did beat, but I think what's driving the stock a little bit is the company pledged to really slash spending quite a bit in the upcoming year due to softening demand. So the softening demand is not a good story from a revenue perspective, but it is good that the company is reacting, should maintain some profitability over at TSM. Now, the company expected to spend as much as $44 billion in the upcoming calendar year. Now they're saying they're going to spend between $32 and $36 billion in 2023. They spent about $36.3 billion in 2022. We also got guidance for the upcoming first quarter for TSM as well. Revenues coming between $16.7 billion up to nearly $17.5 billion. Again, we just printed a quarter where we did $19.9 billion. So the company definitely seen some softening of demand. In fact, they say that we forecast the semiconductor cycle to bottom sometime in the first half and see a recovery in the second half of 2023. That's really been my macro thesis for many months now, is the first half's not going to look great. Back half of the year is going to look pretty well. I think investors are going to anticipate that and actually run up stocks in the anticipation of that second half. Now, gross profits between 53.5% up to nearly 55.5%. Operating profits between 41 and nearly 44%. We'll get to those revenues here in a second, but I did want to show you that the gross margins in the most recent quarter were 62% and the operating profits were 52%. So this guidance for 53 to 55 and 41 to 43, definitely on the low end compared to the fourth quarter that they just printed. Now, let's flash back to the revenue estimates for the upcoming quarter. Again, we'll walk through Q4 financials here, but it's all important, the guidance and the upcoming revenues that we have. Again, the company projecting between 16.7 up to 17.5. Now, the company regularly sandbags. So the company projected $19.9 to $20 billion. They essentially hit that on the nose when it came to that guidance for the revenues, but for the gross margins and the operating profits, they really hit it out of the park. But Wall Street was expecting a number for the upcoming first quarter closer to about $18 billion. That would represent about 6.5% growth. So they're actually coming underneath that, even on the high end of guidance. But again, when you look at the performance of the stock today, up 6%, Wall Street really doesn't care. Now, let's jump into some of the slides. What I wanted to show you is obviously this company is supplying a lot of chips to Apple, and we're awaiting Apple's results really just about 2 weeks from now. And what I notice is probably not good for Apple. Here's your growth rate by platform quarter over quarter, and this is in a smartphone type quarter where they're producing a lot of units for Apple, or conceivably a lot of units for Apple, and you're seeing smartphone demand fall by about 4% in the most recent quarter. Now, when you look at growth rate, you stretch it out kind of year over year, smartphone up 28%. So I think it's pretty safe to say that Apple will likely struggle a little bit on that revenue side when they report their earnings, but it's probably being priced into the stock to a certain degree. Now, let's jump over to these financials. Always a little bit difficult because of the small font, but also the fact that this is a Taiwanese company, so they print some of their results in these new Taiwan dollars, and they've got USD on the far left-hand column. We kick things off with a balance sheet, and you see how just an enormous amount of cash this company has, over $43 billion. They also have this all-important property, plant, and equipment, which we are learning is very valuable. Okay, it's very difficult to scale up this type of business as they are trying to scale up their business out here in Arizona and other parts of the world. You're seeing Intel have to partner with people and get very generous government subsidies in order to build up these property, plant, and equipment in order to make these chips. So this $87 billion worth of property, plant, and equipment, very, very, very valuable. You've got total assets of $161 billion balanced off by total liabilities of just $65 billion. Very financially healthy company. And if there wasn't that Chinese risk on this company, well, this stock would probably be a lot higher and get a far bigger multiple than the 12 times forward earnings that it currently trades at. Now, when you come over here, we see the net revenues of $19.9 billion year over year. That was just 2% growth quarter over quarter, so kind of a flat quarter. And it looks like they're projecting that into probably Q1 and even Q2 of next year, or I suppose it's this year now into 2023. Kind of flattish, maybe even negative growth on that revenue side. And then they're hoping for Q3 and Q4 to see a bounce back. Year over year, though, that was nearly 43% growth. Now, what we love about this company, off $19.9 billion worth of revenue, they have just $7.5 billion worth of costs. So it gives you just massive gross profits of $12.4 billion. That was 5% growth year over year and 68% growth year over year as they kind of expanded margins on that side. Now, operating expenses, not a lot here, just $2 billion worth of total operating expenses, which is particularly impressive off of nearly $20 billion worth of revenue and $12.4 billion worth of gross profits. Those operating expenses were up 7.2% quarter over quarter. When your revenues grow 2% and your operating expenses grow 7%, not a trend that you'd like to continue. But again, company is projecting that to be a shorter term type of thing. They grew 34% year over year, but again, your revenues grew 43%, outpacing that expense growth. So you get income from operations at $10.4 billion, again, off of nearly $20 billion worth of revenue, to have nearly 50 cents, actually a little over 50 cents on the dollar flow all the way down to income from operations is just spectacular. After you pay some income taxes and some other expenses, you're left with about $9.5 billion worth of net income. It's just spectacular over at this company. When we get over here to cash flows, obviously the company is spending a lot on their fabs out here in Arizona, in Taiwan, and across the world. That is what chews up a lot of the money. So we'll talk about that here in a second. But we've got a yearly view of about $76 billion worth of net revenues, $45 billion in gross profits, and nearly $38 billion of operating income. Just really, really impressive. Here's where you get a better view of the company. When you come down here and look at cash flows, now we've got it on a yearly view. I'll show you it here in a second, kind of on a quarterly view. Unfortunately, it's in the Taiwanese dollar, not the United States dollar, but I'll show it to you here from a yearly perspective. So the company generates $54 billion worth of cash through their operating activities. So a shade over $10-12 billion a quarter in terms of its operating cash flow. Now, they have to spend a lot on that property, plant, and equipment. And you see last year they spent $36 billion. And we talked about for the upcoming year, the company is expected to do between 32 and 36. So that should remain relatively static. So off $54 billion worth of positive cash flow, you burn through about 36, so nearly $37 billion on property, plant, and equipment. In terms of all your investing activities, it was nearly about $40 billion. You issue some debt, you pay down some debt, and you pay about $9.5 billion worth of cash dividends. You end up about 6.7 down here on the financing activities. All of it adds up to nearly $9.3 billion worth of increases of cash over the last year. So despite the heavy investment, the company generates so much positive cash flow that it really, really flows down to the bottom line. You see a better view of it here. Now, this is in not a new Taiwanese dollars. You've got your beginning balance here. This is cash. You went from 853 up to 1.3 billion, or in this case, trillion, year over year. I'll probably refer to these as dollars, but you get the idea. Now, the cash from operating activities came in at 486. Here's your capital expenditures. Again, what I just showed you was kind of on a yearly basis. This kind of gives it to you on a quarterly basis. So 486 in revenues, you spend 336 on building the plants and all those types of things. You pay 71 in dividends. You've got some other investments down here, and you've got free cash flow coming in at 150. Last quarter, it was 146. A year ago, it was at 142. So just steady cash flows, even in a difficult environment. So even as they project that the semiconductor industry might cycle to the bottom in the first half and second half of the year. The company just has so much runway. Now, what's a thing of beauty is this stock chart. We're on a weekly view of TSM here. We've got it going back all the way. I mean, you could stretch it back even further if you want. It's really been in a long-term uptrend since the late 1990s. I mean, you can actually stretch this uptrend. It doesn't fit in here perfectly. It really starts to form right around the bottoms of the 2008 market. And you see here, this stock, whenever it touches this green line, is an absolute buying opportunity. And you had that buying opportunity back here in October when many believe, including myself, that this is likely the market bottoms back here in October, because you've broken out of this downward trend. This trend is over. And once you break out over it, you're starting to create higher lows. When you start to create these higher lows, these are incredibly steep, and they are likely to be followed by some subsequent pullbacks. And when you have this type of formation, you can buy the dip. It doesn't mean you buy the dip with both hands and you jump into the pool with no clothes on. But if you like TSM, if you're comfortable with the political, geopolitical risk of those types of things, and you're comfortable with the amount of investment that they're going to make, and likely some competition coming online at some point from Intel and maybe some others as well, well, this is a company that you can buy on some kind of subsequent dip. A great dip would be all the way back to this green trend line. That would take you back, maybe back to about $74, $75 per share. Probably more likely is it falls short of these lows that we made back just a couple of weeks ago, really just 2 weeks ago, back here at about $78. I wouldn't chase this stock on this kind of momentum rally. There'll be some short-term profit taking, but this longer-term uptrend is absolutely still intact with TSM, and it's intact with a lot of stocks. So I encourage you, even if you're not interested in TSM, to kind of really get the broader view. Switch yourself to kind of a weekly, even kind of a monthly view of any kind of stock that you're looking at, and just see if the longer-term trend is still intact. I know there's a lot of short-term noise. I know there's a lot of short-term uncertainty, but these longer-term trends with a lot of these stocks are intact, and if they have shown a very clear sign of reversal like TSM has. We were looking at bank stocks earlier in the week. They also showed this pretty clear sign of reversal. When you get subsequent pullbacks, because the market's going to pull back, that can be your opportunity to buy with a little more confidence. That was TSM. It's off to a strong rally to the start of 2023. The technicals look good. The fundamentals look good. If the company is correct that the back half of the year looks good, well, that's probably going to be a good thing for this stock. And a lot of stocks, as investors will likely accumulate before that actually comes to fruition. That is why you're always looking ahead with the stock market instead of waiting for the signs to become as clear as day, because by then you're usually late to the party. Hopefully you guys have a wonderful day out there. We'll be back again tomorrow with bank earnings. Good luck with your investments.